Welcome, and thanks for tuning in to the Talking Banks podcast. I'm Kevin Swanson, Senior Analyst with GenOpp Capital Management, and joining me today is Joe Fenech, our Founder and Chief Investment Officer. Before we start, a quick disclosure. Joe Fenech, Kevin Swanson, and Jeff Wallenius are employees of GenOpp Capital Management, an investment advisor that maintains exempt reporting status in the state of Indiana. This podcast represents the views, beliefs, and opinions of GenOpp members and does not assert to be complete. The information presented in this podcast is provided to you as the dates indicated, and opinions presented may change. You should not rely on this podcast as a basis upon which to make an investment decision. This podcast is not intended to provide and should not be relied upon for tax, legal, accounting, or investment advice. GenOpp's clients or its members may hold or recommend to GenOpp's private fund clients the purchase or sale of securities of companies discussed in episodes of this podcast. So on our last podcast, we talked about these sort of dueling considerations, where on the one hand, the banking industry in a vacuum is in the best shape in over 20 years. The fundamentals of the business center around margin improvement, a new era of bank regulation, M&A consolidation wave kicking off, and historically attractive valuations. On the other hand, the main risk is this sort of perpetual state of crisis that we've been living in for a while now, and banks seemingly at the tip of the spear are uniquely exposed in a negative way to this constant turmoil. So, Joe, why don't we start there with an update on where you think things stand in that regard?
Thanks, Kevin. So we made those comments in a podcast a few months ago, and I think both sides of that debate have continued to play out. The fundamental story is compelling really for all banks at this point. The smaller banks, which are much more reliant on traditional spread banking, the incremental margin of that business today is the best it's been since prior to the '08 crisis, almost 20 years ago. You've probably got a few rate cuts here in the medium term, on the medium term horizon. So the short end probably comes down a bit, but the economy still seems pretty resilient. So if you assume the long end holds in this range, the yield curve is set to steepen even more. And in past cycles, we made the point that the process to get to a steep yield curve is typically pretty painful because the Fed's usually looking to solve for some sort of credit dislocation, and you don't have that this time around. So your smaller banks relying on spread income, really up through the regional banks, that's going to be beneficial to them. For the largest banks, those stocks have performed better so far to date, but the capital markets businesses are just beginning to bloom. And at the same time, the stress test results have made pretty clear the enormous pile of excess capital these banks have to work with to put to use for the benefit of shareholders. So you have this capital markets story coupled with the benefits of deregulation. So the bottom line is nothing's changed relative to the favorable backdrop for the sector that we outlined last time. In fact, it's probably even a little better and happening at a quicker pace than we thought it would just a few months ago. At the same time, the main risk that we identified has also played out over the last few months as well, and it's sort of kept things on edge, right? So just like tariffs earlier this year and the irrational fears over commercial real estate last year, and the liquidity challenges of 23 and the geopolitical conflicts that erupted in 22 and the pandemic before that, I mean, the situation in Iran last month just sort of popped up and was in keeping with this perpetual state of crisis that we seem to be living under for the last half decade for sure, but I would argue stretches back to the '08 financial crisis. And that series of crises has continued to mask what is otherwise a really attractive story for the banking sector. Now, Iran seemed to get settled pretty quickly. Who knows if that holds? And I'm not certainly not in the business of predicting what, if anything, happens next. But it does seem that finally that the skies seem to be clearing a bit. The legislation that just came through Congress, no matter what anyone might think about the longer-term debt implications, it's probably a safe bet to say it's short and medium-term stimulative. Rate cuts, as I said earlier, do seem to be on the horizon. The economy's holding up pretty well. The geopolitical situation, again, by no means settled around the world, but barring any new surprises, we at least know what that is. Tariffs are still a big wild card, especially with the extension deadline coming up here. But for every contentious situation, there seems to be sort of an offsetting announcement of a settlement with this country or that. And so I don't think it's coincidental that when we get to a place where the banking sector story looks like it's beginning to outweigh the perpetual macro crisis story, if you will, you see the stocks perform really well. And that's what I think we've seen over the last few weeks. and what I think you'll continue to see over the second half of this year, with second quarter earnings coming up in late July, sort of adding the next log of fuel to the fire.
So the stocks have been acting much better. The largest banks, led by JP Morgan, are making new highs. They've continued to outperform as they have throughout the cycle. But the rest of the sector seems to be perking up as well. So maybe walk us through what the decision tree looks like from a portfolio management standpoint.
It's interesting. So in the 2008 crisis, the largest banks were the worst place to be. And then the problems over the last few years after that made their way down to the smaller institutions in the real estate hotspots around the country, like Florida and Nevada, et cetera. In this cycle, which really unfolded when the rate environment changed in early 22, the biggest banks have been the best place to be. The regulatory changes enacted in the aftermath of '08, on the one hand, handcuffed the biggest banks to a certain extent, and you're seeing those shackles taken off really right now for the first time since '08. But on the other hand, those changes also made the biggest banks essentially bulletproof from a safety and soundness standpoint. And so they were the safe havens for sure during the 23 liquidity crisis after Silicon Valley Bank and the others went down. But I think what's overlooked is they also benefited tremendously from the interest rate environment we were in. So they were simultaneously the best defensive play in the bank sector, as well as the best way to play offense, which is a combination that you rarely see. So I don't think it'll surprise people, to learn that JP Morgan stock, for example, has crushed the banking index, but it's also beaten the S&P by a considerable margin since the start of 2020, through what's been a very, very difficult period for the banking sector as a whole. Thankfully, we've had plenty of exposure in our fund to the big banks through these last 5 years. But I think we're at a unique inflection point right now where I think that the big banks are going to continue to perform very well. I don't think, for instance, that people are fully appreciating the extent to which capital is going to be freed up for these companies. The capital market story, again, is unique to the big banks. And so all of this M&A and the IPO markets opening up, they're going to disproportionately benefit from that. And then also, as generalist investors get more excited about the bank sector, they aren't going to initially sell Apple and buy Main Street Community Bank, right? They're going to pile into the sector's headliners, the JP Morgans, the Wells Fargos, the Bank of Americas, et cetera. And the benefits of AI are also going to accrue, I think, initially to the biggest banks. So I don't want my comments misconstrued here on the biggest banks. No one has been a bigger proponent of these stocks than we have. My only regret from these past few years has been not owning more of them than we did. But I do think we're at that point where the relative outperformance is mostly behind us. And that's a tough call to make after all the things I just said, right? But JP Morgan is now at 15 times 2026 earnings and 3 times tangible book value. And look, we still own it. And I can make the case that those multiples should go higher, especially with the market trading over 21 times forward earnings and with JP Morgan producing relatively better returns on capital than the vast majority of the S&P that trades at higher multiples. But I think that from here, that's a tougher argument to make than to say that your average regional bank trading at 10.5 times 26 earnings, and then the next level down from that, your larger community banks trading at 9.5 to 10 times earnings, and below that, your small community banks that no one's really paying any attention to at this point, a lot of them are still trading below tangible book value. I think it's a tougher argument to make with JP Morgan than to say that those banks that I just mentioned will re-rate over the next 2 to 3 years to say 13, 14 times earnings and 1.5 or so plus of tangible book value. So I think you still make money in the big banks. You probably make good money. But the play to me now is in the regionals and the larger community banks where you're going to see continued fundamental improvement. They're going to be in focus from an M&A standpoint, and the stocks are much cheaper. And then below that level, the small community banks will continue to lag for now for a bit, but there will be a time when I think the attention will shift to those valuation laggards. And that will be an opportunity to really generate some alpha when the index settles in and you get these catch-up trades, both fundamentally and through pops from M&A.
Before we move on to M&A, now is probably a good time to highlight some interesting data that I think supports what you just outlined. We certainly aren't basing our outlook on this, but there is a chance it plays out the same way this year. So since the pandemic, with 2021 the only exception, bank stocks significantly underperformed on a relative basis and an absolute basis in the first half of the year, but then outperformed significantly on a relative and absolute basis in the second half of the year. Specifically, the regional bank index on an average is down about 12% versus the S&P up 8%, so a 20% differential in the first half of the year. Whereas in the second half of the year, bank stocks on average are up about 23% versus 8% for the S&P, so 15% outperformance by bank stocks in the second half of the year. Now, the reasons why differ each year, so you can certainly make the case that it's coincidental. A pandemic happens in March 2020, Russia invades Ukraine in February 2022, Silicon Valley Bank fails in March 2023, New York Community and now Flagstar is recapped in March 2024, and this year you had all the tariff liberation day in early April. So those are all obviously idiosyncratic events not connected to each other. They're just all coincidentally occurred in the first half of the year. And then on the flip side, you had the vaccine announcement in November 2020. You had early recovery in the liquidity crisis in 2023. You had a surprise Fed rate cut and the disinversion of the yield curve in September last year. And this year you have some macro clouds clearing, like Joe talked about, and probably a couple Fed rate cuts in the back half of the year. So all this bad stuff in the last 6 years has occurred in the first half of the year, and all the good stuff is in the back half of the year.
Yeah, so I think it's probably impossible to say for sure. So the events could certainly be coincidental, but the data is also the data. And so I wonder about a few things related to this and whether there is maybe an explanation. For most of my career, the months of trepidation, the months where people were always most concerned about the market in general, were October and to a lesser extent September. I'm not sure how much of that was just market lore, the big crash in 29, the big crash in October of 87, Lehman in September of 2008, but it was definitely a thing, right? But it does seem like that's been less of an issue in recent years, and March has sort of been the month to watch, at least for the banks. And I wonder if that's maybe tied to the Fed, where the Fed is now so involved in markets to a much greater extent than ever before in the past. The Fed's balance sheet, for example, was less than 1 trillion in 2008. It went to 4 trillion in response to '08 over that ensuing 12 years, and then it exploded to 9 trillion with COVID and the aftermath of that. So you couple that with all the fiscal stimulus as well, and the Fed also flipped the script from quantitative easing to quantitative tightening and also started to raise rates in March of 2022. And banks, as we pointed out in the past, are much more sensitive to Fed action than most other sectors. Also, as we all know, we have elections in November. And I think the Fed has certainly become more politicized along with everything else these last few years. So maybe you get bad news in the first half of the year and good news in the second half of the year into election season, for example. But I do think there's maybe something to this because this year is shaping up, in our view, to play out just like it has in the last 5 of the last 6 years, right? Since the Fed's involvement in the economy really went into overdrive, where we expect the second half of the year to be much better than the first. So again, it doesn't in any way drive our thesis on the sector or how we invest, but I think it's something to keep an eye on. Like I said earlier, the data is the data.
So let's move to M&A. We haven't seen much of it in the bank sector in the last 5 years due to the pandemic and then the volatility that was unleashed in the aftermath, and that continues to this day. But if you're right about the macro clouds clearing finally here and regulation easing, which we'll talk about later, it would seem that there's quite a bit of pent-up demand for M&A. The M&A wave in 2021 resembled prior cycles in a lot of ways. We had community banks that just raised their hand, ready to sell. And if it was a clean bank with a good market footprint, even if it was a subpar performer, the chances were high that an acquirer would come along and pay a substantial premium to market. And that price for your typical community bank in a good market at around 1.7 of tangible. Also, since 2020 was really the only year of the interruption in M&A cycle to that point, there really wasn't all that much in pent-up demand.
I think that's right. But now with the window opening up, things are different. You didn't have interest rate marks to deal with in 2021. That makes the deal math today more challenging, meaning that tangible book value today really only reflects a subset of the securities portfolio that is already marked to market, right? It doesn't reflect the fixed rate loan portfolios that are probably still substantially underwater today because of the rise in interest rates over the last several years, nor does it reflect the held to maturity investment portfolio on a mark to market basis. And at the same time, you've now had 4 of the last 5 years with no real M&A activity to speak of. So those CEOs and boards that wanted to sell 3, 4, 5 years ago are now 3, 4, 5 years older, and the succession challenges in terms of management talent and depth haven't resolved. And there just aren't enough buyers with a management team and board that I think has the appetite, the depth of talent, and the stock currency to absorb all the banks that want to sell. So the balance of buyers and sellers is out of whack. There are more sellers than buyers. So for a lot of community banks, the dual challenge of those interest rate marks and the imbalance of buyers and sellers, that's going to limit, we think, the market premiums paid for a lot of community banks that we're going to see in this cycle relative to prior cycles, especially in the early phases of the M&A wave. Now, there will be exceptions, right? You know, we just saw a deal a couple months ago in Virginia where Town Bank paid a multiple in line with prior cycles for a small bank called Old Point. So there will be situations where a selling bank doesn't have prohibitive interest rate marks. They're in a market that's desirable. And just as importantly, there are several other banks that want in that market and have the capacity and the currency to do the deal. In those instances, you'll see, you know, big premiums to market in line with historical valuations, but it's not going to be, I think, a frenzied M&A market where everyone's going to get the multiple they want or think they deserve.
So that seems to make the case for owning a select group of community bank sellers, but the acquirers are going to get some good deals here too.
Yeah, I think there's a real opportunity to own the intelligent acquirers here, especially because these interest rate marks are a temporary phenomenon, right? The balance sheets are going to remix over time, and these are customers that the acquirers are going to want to keep. Unlike in '08, when you put a big credit mark on the target's portfolio, and those are customers you didn't want to necessarily keep. But with a rate mark, these are good customers, right? For the most part, they just have to be repriced to reflect the current rate environment. But you don't have to pay the target bank for that remixing, you know, 3, 4, 5 years down the line. You don't have to pay for that today. So if you can make the math work, and better yet, the target has a management succession issue too that they need to address, the acquirer gets a pretty good deal. And they spend the next few years remixing the balance sheet. You know, I think of South State's acquisition of Independent Bank in Texas as a great example of that dynamic.
Speaking of South State, and not to get too in the weeds here on accounting, but another point in favor of the acquirers here is the evolving philosophy on how to value EPS accretion in a merger deal. Maybe to simplify the explanation a bit, in the aftermath of '08, companies would take a huge credit mark on the acquisition, and there would be what's called an accretion cliff, where the credit mark on a loan would result in asset yielding, let's say 20%, maybe even higher. But that asset couldn't be replaced at anywhere near that yield. So you'd have this earnings juice, for lack of a better term, for a period of time. And then when a 5% yielding asset replaced that 20% yielding asset, the income would fall off. And so the market would rightly value that temporary earnings stream with a lower multiple.
Right. And what South State has rightly pointed out, and I'd point everyone to their first quarter 2025 earnings call transcript for their explanation on this for South State, and we agree with it, is that with an interest rate mark, you're writing up the value of, let's say, a 3% yielding loan to current market rates. But when that asset matures or pays off, you're now able to originate a new loan at a comparable yield to what's rolling off. So there's no accretion cliff like before. So in effect, it's no different than a bond restructuring, except this is even better because it's not a permanent destruction of capital like we see in a bond portfolio restructuring. And there's no accretion cliff, but the assets being replaced at a comparable rate. So you value the accretion differently, I think, in that instance than you would with a big credit mark. I think that South State said 80% of the mark in that deal was interest rate related and 20% was credit. So bottom line, some of these acquirers are going to get really good deals, but you really need to understand the circumstances of each and every bank, both buyer and seller, more so I think than in past M&A cycles. And that's going to lead up to opportunities, I think, to play this M&A theme both long and short over the next several years.
And how will the complexion of M&A differ for the larger banks?
I think it'll differ quite a bit for the larger banks, and this is where the nuance of this theme is important. So, the deregulation of the sector is going to have a really important effect as it relates to M&A. You've got capital that's now freed up, but also a more open-minded approach on the part of the regulators to regional bank consolidation. So first and foremost is the question of scarcity value. Outside of the four big trillion-dollar asset banks and excluding Goldman and Morgan Stanley, there's only 29 banks in the country over 50 billion in assets. And of those 29 banks, only 10 are based in the Southeast and Texas, where everybody wants to be because of the demographics. So if you're a large regional bank that wants to scale, and Bill Demchek at PNC, I think, articulates the rationale for this better than anyone else. And now you have the green light from the regulators. There's not many options for you to be able to scale, right? And to really scale, for instance, if you're even a $500 billion in assets and you want to join that $1 trillion plus too big to fail group, you either need one giant deal of a similarly sized company, or you need to buy a few large regional banks. And so, unlike with the community banks where you have more sellers than buyers, with these larger regional banks, I think it's the opposite. There's probably more buyers than sellers, or at worst, it's sort of an equal match between the number of buyers and sellers, right? So supply and demand is in balance there. The interest rate marks are also less prohibitive for these regionals than they are for the community banks. So you put all that together, and we think the nice premiums in this cycle are going to be seen in the regional bank selling group. You'll also see a few merger of equals among this group, so obviously not much premium there. But overall, the consolidation in regional banking, we think, is going to more resemble the prior cycles of community bank M&A. In other words, more traditional buyer-seller M&A with nice premiums to market. So before we close here, I did want to make a comment on the recent passing of Gerry Lipkin, who was the longtime CEO of Valley Bank in New Jersey. When I was a sell-side analyst earlier in my career, I was assigned coverage of Valley. And as a young analyst, even though you're covering the company and authoring opinions and making judgments on the stock, you're also learning a lot at the same time. And I personally learned quite a bit from Gerry. He was a former regulator with the OCC before he took over as CEO of Valley, and he had a unique understanding, I felt, of credit, and he had a really firm philosophy that he really stuck to over the years, and he steered the ship at Valley very capably, I think, with that mindset. And the thing I'll most remember is warning any investor who would listen in the years before the financial crisis about the pitfalls he was seeing in things like subprime lending and some of the underwriting standards that we saw in banking in the early 2000s. And he was saying all this before it became obvious to everyone else, right? And then things started to go haywire in '08. And one of his favorite sayings that I stole from him and still use in just about all of our marketing materials for the fund, well, he used to say, it's the return of principal, not the return on principle, that matters most in making a successful bank. We did a few road shows to London in the years after the financial crisis. Not only were they a lot of fun because Gerry was great to be with, but with the big banks having struggled the way they did in '08, Gerry really provided to these foreign investors not only a retrospective of what went wrong here, but also a prescription for how the industry could get back on track. And I really think, the solid footing the industry sits on today really reflects a lot of Gerry's philosophy, which was consistent and really never wavered throughout his career. As a regulator, and then from his time as Valley CEO, beginning in the late '80s through just a few years ago. So I was sad to hear of his passing. I wanted to offer my condolences to his family and his former colleagues at Valley Bank. Ira Robbins, Valley's current CEO, has a really great post on LinkedIn that articulates a lot better than I can about what Gerry meant to the company and the industry.
On that note, we're going to wrap up. Thanks to everybody for listening. Hope everybody has a great day.